Good.
Good afternoon, everyone. My name is Kimberly Wahama Deshane, and I'm the Operations and Events Manager at Northern Ontario Angels. And on behalf of our NOA Board, Executive Director, and consultants, we thank you for participating in our NOA virtual event featuring a fireside chat with Tony Orsi, partner of Bereskin&ParrLLP, Mary Long Irwin, Executive Director, Northern Ontario Angels, and Peter Bianco, NOA consultant. Before we get started, just a few Zoom items. We do ask that you mute your audio and video channels during the presentation, and in the event of a power outage, if we lose connection, we will hotspot to a phone and you can reconnect in the Zoom link. We will be recording this presentation and can provide a link following the event via email. Should you have any questions for the presenters, I do ask that you type them in the chat window and I'll facilitate the questions to the presenters. We've put all of your names into a draw at the end of the presentation for a $500 consultation with Bereskin & Parr. On behalf of Northern Ontario Angels, please welcome our panelists to the screen as we begin our fireside chat, Legalities about Entry Points, Exits, and Valuations, sponsored by Bereskin & Parr LLP. Tony?
All right, well, thank you very much, Kimberly, for that introduction, and welcome to everyone who have signed on to attend our virtual event today. We're very excited to have you here and to speak with you about looking at different aspects of investing in a startup and exiting from your investment. So I'm going to start off and I'll talk about entry into an investment, into a startup through investment, looking at it from the intellectual property perspective, since that's our background in terms of what we do. However, there are other legal considerations to think about as well. When you're looking at investing in a startup, and there's going to be various corporate issues to sort of think about as well. So you want to check on that too. However, from an IP perspective, I think to start off with, one of the things to do would be to educate yourself in terms of how intellectual property works. The different types of IP rights that are out there, the different, things that they can be used to protect, and, try to come up with your own answer in terms of how intellectual property may apply to the startup that you're looking at investing in. And this really depends on, the nature of the startup, the type of business that it's in, whether it's, very tech heavy or not, whether it's very important for them to get to market very quickly and gain a lot of traction and get a lot of subscribers in. So you want to take these different things into account as, they may place more emphasis on certain types of IP rights compared to others. So, as I mentioned, if it's a company where, they're really focused on getting to market fast and building that leadership position, maybe they have a software platform where it's important for them to get a lot of users, for instance, then they in that situation, they may be focusing more on the story that they're telling, and perhaps the branding would be more important in that regard. And so that's where trademarks would come in, for instance, and trying to think about how trademark protection could be applied. If it's a startup that's more technology focused, where there's a lot of investment in terms of research and development, and there might be a longer runway to commercialization, then patent protection might be more important there for helping them to differentiate their technologies from those of their competitors, as well as trying to build a moat around what they're developing and keeping others out from commercializing what they've developed. So some examples here could be, for high-tech startups, perhaps med tech, pharma, for instance, or even heavy machinery. Those are all examples where patent protection might be a bit more important. And, it might be important to look at that as well in terms of reducing investor risk, sorry. Another type of IP right is copyright protection. And so that, plays a role with respect to content that's created, any sort of creative work really by the startup. And so again, depending on the nature of the business, this might be something that might be more important to them. For instance, if they're generating a lot of stories and videos and they want to make sure that they're protecting their content and preventing others from copying it and using it without their permission. Trade secret protection is also important to consider as well. And there are various types of sensitive information that a company would need to put agreements in place and other sorts of safeguards to keep that information confidential. Perhaps it could apply to, some sort of know-how that they've developed, or, if they have some back-end software that others don't have access to and it's very hard to come up with, it could be more important to them. And then there's other things like, terms and conditions and privacy policies for company websites. But usually, intellectual property strategy is based on a combination of those different IP rights, that I spoke about. And another thing, that would be good to think about too would be, how is IP used by other companies in this space? So you can see what sort of patent and trademark filings there could be, what sort of space there is left to operate. Are these companies building large IP portfolios? How will that affect the startup's ability to compete? These are different things to think about. So, once you've done your homework in that regard, the next thing that you could take a look at and trying to, do your investment assessment here is looking at the startup's intellectual property plan. So, checking with them to see, what sort of strategy do they have, and does it align well with their business goals? As we spoke about, the different types of IP rights protect different aspects. And so, again, depending on the startup, they maybe focus on some IP rights versus others. There's not a one size fits all sort of thing with respect to intellectual property. So, you need to sort of assess that on a case by case basis. But I think the most important thing here, though, is that you want to look at what the core assets of the startup is, the things that give them value and help them to have a competitive advantage over the other companies in that space. And then try to see how the IP strategy that they've developed, aligns with their business strategy and protects the core assets and is used, to build value for the company, as well as to, help with risk mitigation. So those are, a few things that you can ask the startup about in terms of, what they've thought about as being important for them to try to acquire or, try to set up in terms of IP rights, at the current point in time, as well as in the future, because they should be looking out in terms of how their commercialization is going to be rolled out, what their product and service pipeline is going to look like over time, and see what sort of IP rights they can put in place as that further develops. So I guess the one thing is that it's not necessary that they have everything protected. Again, the focus here is on value, and so from the point of view of, say, patents, for example, the focus would be on trying to protect the core aspects of what they've developed in terms of innovations, and not necessarily patenting everything, basically. So you have to be strategic about that. The other thing that would be good would be to get an idea about their budget as well, so that you have an idea of what that sort of expenditures are going to look like, both at the current point in time as well as in the future. Intellectual property does get more costly as the portfolio grows over time, so it's very important to plan for that and to make sure that there's funds in place to support that. Another thing to look at as well is, as part of that process in terms of, I guess, kicking the IP tire, so to speak, for the startup, you basically want to see that they have their house in order, their intellectual property house in order. And so basically look to see if they can provide you with a report of all of the IP assets that they've currently have registered or that are pending, for instance, and then also to make sure that they have the appropriate agreements in place with respect to ownership, employees, contractors, even other organizations where they may be engaging in projects with, joint projects with. And basically making sure that the startup has the ownership rights to the IP, and that there's clauses in those agreements with respect to confidentiality, so that they're maintaining their their advantage, their know-how, secret, and not letting it slip out, and also with the parties that they're engaging with, that they would be using the IP in a certain way and not sort of abusing that. Other things to think about too would be, whether they would have licenses in place if they need to license in technology, for instance, in order to commercialize. And also, if it's a software company, looking to see if they've done any sort of open source software audits, since if they're using, open source software, in some cases, depending on the licenses that apply, it could be pretty restrictive. So it's a good idea to get a handle on that too, to see how it might impact the commercialization of what they're developing and their control over it as well. So yeah, just sort of roughly, those are some of the things that I guess come to mind when you're first looking at engaging with a startup that you're interested in investing in, and then looking at it from an intellectual property perspective. And I'd be happy to answer any questions on this after in the question period. Thanks. Mary, on to you now.
Thank you. Thank you. Actually, that's very, very interesting. We look at, when I say we, our investors look at all types of deals. And so I'm going to speak today about valuations, because that's really important. Like, sometimes you will come in with an ask and an investor will look at the valuation that you believe your company is worth, and they'll ask you, how did you arrive at that evaluation? And are you prepared? You really should be prepared to back it up. Investors look at sales, gross profits, assets, as well as any commitment for upcoming sales. They look at your drive, your determination, your commitment. All of those they take into consideration. But sometimes it can be really challenging to get to a value for your business. And when that happens, that there are times where I may use or recommend that you use a valuation company. But for the most part, it's a good way to start that conversation with the investor. Typically, unfortunately, what we see a lot of is, say, for example, you need $500,000 to get your new IT project up and running. And so you say to the investor, I need 500,000 and I'll give you 10%. Well, what you're telling them in a rough way is your company's worth $5 million. I would first ask, how did you arrive at that? And what makes your company worth 5 million? And the answer I get back lots of times is, no, I'm not saying it's worth 5 million. I'm saying I need $500,000 and I only want to give up 10%. So, you have to be mindful of what you're asking and what you're saying. Just because you need it doesn't mean that it's the right evaluation. And sometimes and then I'll hear back, well, in about 3 or 5 years, if everything goes well, I'm going to be making profits of 3 million or 5 million. So yes, it's worth it. But the investor is investing in what is going to happen in the future. So they don't want to pay what's going to be in the future. They don't want to pay for that now. And I'm going to liken this to, if you are purchasing a house and you see this house, and the asking price is 500,000, and you look at the house and you think, oh my goodness, I need to redo the bathrooms, redo the kitchen. I have to put in $150,000, $200,000 worth of renovations. And the seller says, yes, but once you do that, it's worth $500,000. And that's what you're saying here. So you have to be really mindful of what you're asking. Investors invest for a number of reasons, but they do want a return on their investors. Pardon me, on their investment. So they're hoping that your sales will be what you believe it's going to be in 3 to 5 years. So that's how they make their money. But that's not the only way that investors look at for value. And sometimes it's a fluid moving target, if you will. It's hard to say what it is for a brand new company. You put all of this time and energy into developing this. You've got this wonderful idea, and it could really grow some good legs and be very successful. So there's other things that will help. Number one, I would say, if you're coachable. That's one of the biggest complaints I get from investors, is that a company founder is not coachable. They will say, no, I just want your money. I don't need your advice. I know what I'm doing. That doesn't open up the door for nice, warm, fuzzy feelings of working a relationship, because your investor, in essence, is also your partner. Also, you should have proof of concept. Is it a strong, hard proof? What how did you determine? Did you just say, well, I talked to my friends and they all said they would buy it? That's not proof of concept. You need to really determine if people are actually, number one, interested, and number two, going to buy. I was watching a program, I think it was on Dragon's Den the other night, where they had an app that you could put on your phone. And so you could use this app, and what it meant is it would delay calls, so that way you wouldn't be getting personal calls until you got home from work, for example. And one of the investors said, well, why don't I just shut off my phone? Why would I buy that app? And he said, well, I don't know, but I think it's a good idea. So, you really need to check proof of concept. And also, when you pitch to the investors, are you showing a lot of commitment to this idea? Are you going to work at it full time? Are you showing a lot of compassion, that you truly believe in it, and that I, as an investor, can look at you and feel that passion? That's really important. And if you have any current sales, how are you going to expand on it? What's going to make you different? What's going to make you grow? What's going to make the sales continue to rise? You have to remember, at times at times you can we look at lots of different ways of getting investments into a company. It's not all just a percentage of your company. Sometimes if you cannot reach a certain evaluation, you could go in with convertible debt, meaning that you've agreed to take on this debt. And in 2 years, if you reach your sales and you do all of the things that you were saying you were going to do, and the company's valued at that, then you can convert that debt into shares. You can also, we have a lot of investors that do very unique investing. Say you're manufacturing and part of your investment is because you need a building or a location. The investor may say, I have a building, or I know somebody who has a building that you can use for 5% of your company. You can use this building for 3 or 5 years, not paying any rent. Or the investor may say, what you really need is a line of credit to get you through the ebbs and flows of cash flow. I will help secure that for you. So there are a lot of different ways. Sometimes it's just straight up, you invent something. Let's say you have the perfect, beautiful office desk chair, and you're making a lot of margins on that. The investor will say, well, for every one that you sell, I want $10 until I get double my investment back. So there's a lot of different ways of looking at it. All I'm highly recommending is that you know your numbers, know how and when you're going to get your sales, show true compassion, commitment, and have proof of concept, and then be open-minded when you're discussing it with your investors. We don't negotiate the deals for you. That is up to you to negotiate with your investor, come to some sort of terms. Each go to your own lawyers, making sure that the term sheet is what each of you understand. And for the most part, it's a long-standing, positive relationship that's built between the investor and the company. And if any one of you have any questions on how this process works, please feel free to ask me, to email me, or to call me. But I truly have seen in the number of deals that we have done that many of our investors have trained company founders to be true entrepreneurs, to be true company managers. And the company founders themselves will tell you that they would not have been as successful, especially successful at such a rapid pace, without the investors. So it's a truly good relationship. If you have any questions, let me know, but I'm going to for now, I'm forwarding it over to Peter.
Thank you, Mary, and thank you very much, Tony. Incredible, great insights and very well said. I'll try to stay within my 10 minutes also, so we can have lots of time for questions. And I'll discuss basically from the real entrepreneur side, what we talk about is exits. What is an exit? Well, there's really three major exits that I'd like to highlight for you. Number one, of course, is everybody's heard about the news of Shopify and their incredible exit being they went public. So an IPO, that's really one of the dreams, that you invest in the small company, you take all this risk, you hope that you're going to get your return on investment, and that type of exit is probably the least, from the reports that I've seen from the ACA out of the United States, which is the Angel Capital Association in the US, and NACO, which is the National Angel Capital Organization in Canada. Looking at their reports and looking at the numbers, the amount of exits under going public are very, very small. However, it's there. The other one being, of course, that somebody really loves within a few years that you're really generating this incredible idea of yours, this venture of yours. Somebody comes along and says, wow, I've got to buy this company. So you have what they call is a buyout. So you, the original investor, depending on how much part of the company you've invested in, get your money back plus your return on that money by somebody buying that company. And normally when that happens, a lot of shares have already been exposed to the investor, have been given to the investors. And then, of course, there is the third type of exit, which I've seen happen a few times, where the company really is quite successful and is generating tremendous amount of profits. And so shareholders say, hey, look, I don't want to go public. I want to keep it nice and small. You're doing an incredible job of exploiting your market, and you're very profitable. Just start paying me a dividend, and I start getting my money back. You, the investor, start getting your money back through continual dividends. So depending on how you've invested in that company, maybe you invested personally, maybe you've invested with your corporation. And that's something that all investors should look at, the pros and cons, depending on how they do make that investment, what vehicle they use to make that investment. Here in Canada, as you know, maybe you don't know, and but your accountants can tell you, is that we have a personal exemption of taxes up to about $850,000 if you own shares in a recognized Canadian corporation. That when that sort of you get your return on those shares, you can take up to $807,000 tax-free. Tax-free. It's a one-time, lifetime amount that you can pull out. So please discuss with your accountants how you can structure that, because if you do it as a corporation, of course, then you have the limited liabilities of being protected by your corporation, and the corporation has a different way of writing off investments if it doesn't seem to work. So those are the three main type of exits. I'd like to sort of maybe just touch a little bit that hasn't been mentioned yet. Some of the statistics that we get, that I've been able to get from the NACO organization, is their 2018 report. And in that 2018 report, they were showing that they've had enough exits to, the average is from 1.3 to 29x. So 1.3 times your original investment to 29.3, with several being over 10 times. So what does that mean, 10x or 29x? Is that means, take a very simple number of, let's say you've invested $100,000. I mean, that, which is a lot. And then you have, after an exit, you have a 10 times. Well, that $100,000 is $1 million. So those are the type of wonderful exits that people as angel investors sort of kind of say, well, did I pick the right investor? Did I pick the right investment? Did I pick the right venture? Will it get to that point when there is an exit, I get my anywhere from, like I say, 2 to 29 time exits. Everybody, of course, knows the story of Google and how Google was started literally on a back of a napkin, and they went to some of the early investors in 95, 96. Same with Amazon. And both companies, of course, if you had kept all of those shares, they were be worth billions of dollars today, and their multiples are in the 1,000 to 2,000 X's. But those are far and few between. You know, the average, for example, the average fund, from some of the numbers that I've seen, are investing anywhere where their exits range anywhere from about 2 to 3% to 7, 10% of exits. So if you yourself have invested in 20 companies, let's say, then you can expect the proportionate share of getting that type of exit. So angel investing is risky. There is no question about it. Any angel investor who looks at what do I invest, a lot of the recommendations in the reports are that you invest somewhere between 5 to maybe up to 10% of your liquid financial assets and no more than that. And the average, some of the best reports and some of the averages of reducing your risk is having a portfolio of investments that range anywhere from 13 to 24 companies. So with that type of investment, let's say you choose 20,000 or 25,000 in each company, gives you the amount of money that you should be looking at in trying to get that portfolio because you're reducing your risk. And, you know, Mary talked about doing your proper due diligence and doing the work necessary. Well, you as an investor, you can either do all the due diligence yourself, and there's all kinds of different resources you can use to check off all the different things you should be doing in your due diligence. And then there's also, you can go and hire your lawyer, your accountant for somebody to do a due diligence report. The unfortunate thing about lawyers and accountants, God bless their souls, most of them have never really started a company, and they have got about zero understanding of what entrepreneurship really is all about and what drives them, as Mary says, that passion, that ability. When you make an investment in a company, those are so critical, absolutely so critical, that you're investing in that type of individuals. But accountants and lawyers don't look at that. They look at really the fine line of what's here, what's now, and what's the liabilities. So they may not be as good of a track to use in terms of doing your due diligence. A lot of angel investors are now investing and pooling their money into a fund. For example, here in Northern Ontario, we are in the process of launching the Northern Accelerator Fund, which we hope to pool a bunch of angels, accredited angels. And we're going to be raising anywhere between $2 to $5 million over the next couple of years. And that fund will be doing a lot of the due diligence. There will be an investment committee. There will be a general partner to manage it all. So that's another way. That's just another way of making investments into startups if you don't want to do the work yourself. But again, you know, please be aware, as Mary said, you must do your proper due diligence, do the proper work to do it before, because angel investing is very risky. And hopefully you'll have the ability, and I think my time is up, you'll have the ability to have a successful exit in some of the different ways that I've talked. And like Mary and Tony, if you have any questions for me, please get a hold of Kim and she'll direct you to myself or one of us consultants that will be able to answer your questions. Thank you.
Thank you, Tony, Mary, and Peter. We have a private chat here from David. He's asking Mary, how much in investments did NOA make in Northern Ontario brick and mortar companies in 2020?
Ooh, that's kind of difficult. I would probably, okay, we have done a total of 370, give or take, deals. I would probably say maybe 20 of them are in bricks and mortar. They're very easy to do, and they also have the biggest tickets. And when I say they're easy to do as far as from valuation. You go find comparables, you pick out you make sure you're in that right ballpark. Investors like it because they can put a mortgage or a lien on the building. So we have done quite a bit. I would say there has been a lot done in the Sault Ste. Marie area, Thunder Bay area, as well as Timmins. They are fairly strong in bricks and mortars. They really like them. And it's very easy. You go to your lawyer makes sure that all of the terms and everything is done correctly. They put a lien on it, and it's easy. It's a mortgage. It's generally 1 or 2 points higher than what a bank would do. That is because you wouldn't go to an investor unless you needed it for what we call smart money. You wouldn't go to an investor. You typically would go to your mortgage company. But if you want the smart money, as we call it, and you need that kind of support, then an investor sometimes is a really good way to go. And if you have enough of a down payment, then the amount that the investor may charge in interest may come down a little bit. If you have very little and you want to use the cash that you have as working capital, then the interest rate might be a little bit higher.
Okay, and part two of that question is what types of return on investment and time horizon would NOA expect from a brick and mortar type of investment?
It depends. It depends. Some of them, they like doing a 10-year mortgage, and that's what they agree. And it depends again on what it is that you have agreed with your investor as to. Some of them, the percentage rate is 12 or 14%, which sounds a lot of money, but the investor may not think it's as much because there is none of your money is put into it, just the investment. You're using your money to run and operate your business, or to, in the case of senior housing or senior condos that were recently being built, you may want to put all of your stuff into the money into the finishings, but you need a mortgage and investor for your overall building. So I believe that one was around 12 or 14%, but our average rate of return right now is about 18%. And it takes our average, when I say right across the board average, it takes about 3 or 4 years. And by that time, the investor starts to see some of their money coming back. Now, on the other really far extreme, it's in some of the area of technology, especially in the area of med tech, new cancer research, we have a brilliant company that's done ways to detect if the type of cancer treatment that you're getting, say for breast cancer, if it's not the correct one, they can tell right away. And so they have a brilliant way of doing that. That took years to get to where they are today. So that rate of return, although it may be bigger, it may be in, as Peter was saying, 10x or 15 times your return. It may be a while before that comes. Whereas something that you are selling or something that you are building, say you want to build a hotel and you have decided that you're going to be one of the brand name hotels. Once the hotel has reached a certain percentage of being done, and you've got the brand name on the door and you're weeks away from opening those doors, then a lot of companies, what they do is they will pay out the investor from a mortgage that is considerably less, and they will pay the investor out. And they will pay the investor out at maybe 18 or 20% because the investor was the one who was right there with you with the money when you were putting the shovel in the ground. So it really varies. It's hard to tell.
Thank you, Mary. I have another question from Leslie. Is there a specific industry focus for NOA, or do you find you default to one or a few due to geographic focus?
I would say we would like to, the investors do like technology deals. We look at just about all the deals. There is a few, it's easier to say what investors do not like. They typically don't like restaurants because restaurants have, they have their own unique challenges. There's a lot of competition. Restaurants come and go. It's a little bit harder. Now, having said that, I know of at least 5 or 6 deals that we've closed with restaurants because they had an excellent track record, because their idea was unique, and they saw that the proof of concept was there. People think about it, at least in Thunder Bay, 10, 15 years ago, you could hardly find a vegan restaurant. Now you find vegan, gluten-free, they're all there. So they will support those. But just generally speaking, restaurants are a little bit challenging. And so is retail, especially clothing. Women's clothing store, very difficult for me to find an investor. Otherwise, right now, our investments sort of break up. They're about 50% in the area of technology, and that includes med tech, mining technology, or the new latest, greatest app on your phone. So, that's about 50%. And then I would say about 5% is real estate. And then we have a fair amount in manufacturing. We do look at right across the board, just about anything that there is. It's just retail clothing has been, I don't know if we even ever did one.
Opening up to the floor for more questions. If you have any, please put them in the chat.
Mary, if I could just sort of pick up on what you were saying in terms of specializing in what sectors. The Northern Accelerator Fund will be specifically looking at four sectors, being exactly what you just mentioned: mining technology, med tech. We will be looking at clean tech, and we'll be looking at kind of an IT which has the potential to kind of go globally, not just an IT of an app or some sort of information technology that you would use just locally. But we're looking for, as investors, we're looking for something that can really expand and scale up to be, hundreds of millions of dollars worth of value as they grow. So those are the four areas we will be specifically focusing on over the next couple, as the NAF.
And I would completely agree. And the reason why, if you take a look at, for the most part, not everybody, but for the most part, investors became members of Northern Ontario Angels for a lot of reasons. And believe me, they all want to get their money back. This isn't gifts that they can, I'm sure they have enough kids that they can gift to. But they come here because they want their kids to have jobs. They want their grandkids to have jobs. And so they want to help create those jobs in our community. And those very top four things that you talked about, IT, mining technology, med tech, clean tech, clean energy, those are what a lot of the kids are going to university and colleges. This is what, and so when you come and you have a college or a university degree, and now you're looking for a job, and all we do here is none of those, then you move to Mississauga, Toronto, or wherever they are, then you meet somebody, you have kids, then the grandparents, which live in Northern Ontario, leave to be with their grandkids. And so the investors really decided, and they have come through in spades. They have stepped up to the plate and made sure that we have had technology businesses here and a growth of that here that we've never seen before. We have brilliant minds here in Northern Ontario that has developed and developed patents and came up with these wonderful, brilliant ideas. And they can be located here in the North. They don't have to move to Minneapolis or to Toronto or to Silicon Valley. Yes, some of them go and still move forward, but others stay right here. And I believe that's because we have had the collective support, financial and all kinds of support from the investors. And that's a growth. And I'm really pleased to see that the Northern Development Fund is doing that, is looking and focusing on those to make sure that we have this type of technology and this type of growth right here in Northern Ontario.
Yeah, I'll support that 1,000%. One of the reasons after, 40 odd years of being in business here in the local Sudbury area, where the number of young people that used to be coming into our retail establishment and asking, hey, Peter, God, I've got this idea. I've got this wonderful thing that I think really would make sense from the next venture. Can you help me with it? And unfortunately couldn't do it then. But certainly over the last 5 to 6 years, we've been able to make a real mark for what NOA has been able to achieve here and specifically within our region. And that is that we have the funding, we have the mentoring, we have the coaching, we have the legal, the accounting to be able to support them. And now the world, basically the world, because you have investors in NOA from around the world, they're looking at what we're doing here. And kudos to you and the team that have put together this incredible result over the last 5 to 6 years, because we're getting requests from everywhere. We've got like 4 companies right now that are really looking seriously at how they can either move up here and or locate parts of their business here. So again, supporting what you're saying. Yeah.
I really appreciate that, because just before we got on this call, we were discussing how many new investors were signing up with us. And you're right, they're coming from all over, but also a lot from Northern Ontario. And we may not have all of the resources here, but that's what part of the Northern Ontario Angels does. So now we have developed a great relationship with Tony and the office at Bereskin&Parr to be able to do patents. We've developed a really good relationship with BDO so that way people can get the correct footing when they're starting their financials. We have investors that have such a wide network and such strong experience that they can open up doors. Say you've invented something and you need to get it in Canadian Tire. We have investors that do that. And so it could take you forever to open up that door to Canadian Tire, whereas the investor can just open it for you. And so we're very fortunate here in Northern Ontario. It's been an amazing journey to see in Northern Ontario. And if I could just digress for 1 minute, I was in Chicago a year and a half ago, and I was not part of that meeting because my flights were late. So when I walked into the room, people started applauding, and I turned to look, and they said, Northern Ontario Angels is #1 in North America. And there were people whipping out their smartphones trying to find out where Northern Ontario was. And they were saying things like, what? We picked out, a number of other large cities, but we have a committed level of investors that really are committed to the North and making this work. And we're fortunate, we're funded by FedNor and we're funded by NOHFC, so that way I and our consultants on the ground can focus on getting the matches between the investors and companies and turning out successful 300 or over 3,000 full-time new jobs. That's a big deal for us.
Okay, we have a couple more questions. Which companies, organizations would you recommend for market research in Northern Ontario?
I'm sorry, can you repeat that question?
Which companies, organizations would you recommend for market research in Northern Ontario?
I'd probably, Mary, just very quickly step in there. Is most of all of the regions here in the North have a regional innovation center. I would suggest that you look, and whether if it's in Timmins, Sault Ste. Marie, Sudbury, North Bay, and Thunder Bay, the regional innovation centers are getting just a whole bunch of resources. And from there, you can tap into what the NACO structure and what Mars Discovery District out of Toronto, which has a whole bunch of resources of market research in any kind of sector that you're looking for. So I would probably either look at maybe starting off with the Chamber of Commerce in your local community, and second of all, going to the Regional Innovation Center, both of which have got resources that they can pull from to investigate any kind of sector you're looking for.
And then we also have colleges in each one of our communities. They have marketing classes, marketing groups. We also, one of our sponsors is Fire Dog Communications, and we use them as well for a lot of our marketing. So we have some really good local companies. And as Peter said, talk to the innovation. If you have an innovative idea, go to the innovation centers. I mean, we work together on a number of clients. We know in Northern Ontario, we don't work in silos. We know that when you work with partners and partnerships with other organizations, it works much better. Our ultimate goal at the end of the day is grow a prosperous Northern Ontario, create jobs, keep a place where your kids can actually find jobs here and be happy in what they're doing. Or better yet, your kids can start their own companies.
Okay, we have another question. Specific plan preparation experts that NOA may be recommend in sync with approval and disapproval criteria.
I'm not sure I understand what that question.
Shiv, can you ask your question?
Maybe I'll take a look at it.
If I can maybe take a stab at it, Mary, I'm just wondering if the question is referring to who do you get to do some of the due diligence? Is that sort of part of the question? And how do you go about doing your own due diligence? Maybe is that part of the
preparation of detailed business plan? Yes.
Okay. We're really fortunate again in Northern Ontario. I guess you can tell I really like it here, but we're very fortunate that we have Northern Ontario Heritage Funds that does look at a number of business opportunities in which they put in what they call non-repayable grants. They also do the due diligence. I use our accountant for some of them. A lot of them, and as Peter had said earlier, you go to your accountant or to your lawyer for some of the stuff, but it's a complete, basically a one-pager. You ask all of these questions, you get some of the research, and if you're still not sure, but chances are in Northern Ontario, you can, as an investor, you can pick up the phone and speak to another investor and say, hey, have you heard of this person before? What are your thoughts? Did they work for you? They said they work for you. We're very little degrees of separation here. And so it's quite easy to find a lot of the information. And at the end of the day, I recommend that they look at the accountant to make sure that the numbers and everything they said is correct. And I would look at the lawyer to do some of them. I can remember one investor I'm very close with, and I said to him, go check with your lawyer. And then he came back and he said they were going to give me their house, but they have 3 mortgages on their house, and because they needed a lot of money for just cash flow purposes. So they had working capital because they had a huge monthly costs. And so they told him, no, I own the house free and clear. And when the lawyer checked, they didn't. So needless to say, the investor stepped away. But you have to make sure that you're doing your homework. It's not as expensive as you may think when you're talking about, most of our average deal is $400,000. That means our average check is somewhere around $200,000, $300,000, $400,000. So you might want to spend that $1,000 to get an opinion that will provide information and answers that you may not readily find. And then, there's this world of Google. There's a lot of information you can find.
Mary, I have another question here from David. What does the process look like from first conversation to investment?
The process is very simple. You either call, email, or text any one of us. When I say any one of us, that we have consultants on the ground in each one of the communities in Northern Ontario, or just call me or go online. And if you email me telling me that you want to, that you have this great idea, I will send you back immediately. I will send you back an application. It's a 1-pager. It might take, by the time you're done, it might stretch to 2 pages. But it's very concise. It's how much money do you want? What's your rate of return? What's your exit plan? What are you going to do with the money? Tell me about your business. What makes it unique? It's the very same questions you would expect an investor to ask. I get that back. I do a bit of due diligence. I do a bit of research, a bit of information, may come back to you with a dozen questions or maybe only 2. And once all of that's been done, then what I do is I send that out to the investors and post it on our website, which is a private portal for investors only. So if you're an investor and you haven't got access to that, let Kimberly or myself know. We'll make sure you do. But we post some of them on there, and then it could take very little time. We've done closed deal in a matter of, half an hour, based on due diligence. And some of them have taken longer. Sometimes the investor will say, okay, I'm interested, but I want to see a business plan, or I want to see this, I want to see this. When they say a business plan, they don't mean a comprehensive book. They mean a plan that details what you're going to do, your timelines, what makes you different, how you're going to market your product, who's going to manage what they're looking for is the strengths and the weaknesses, and they're going to try and fill those in. And then then when they're still interested, then I introduce them. And so then the investor will meet with the company, and then the person has one last time to convince the investor that this is a good value for them. I would say, although on average, probably 2-3 weeks.
We have another question from Ian. When is it time for founders to get a lawyer to incorporate and create a shareholder structure?
I would make sure that I'm going to get Tony to answer that as well, but just in my experience, you really need to know, if you're looking for an investor, you really should know what type of investor you want, how that's going to be structured, because that's also an important part, an important piece of the overall incorporation. And I'm going to let Tony take over the rest of that answer.
Thanks, Mary. I think from our perspective, looking at it from an intellectual property perspective, it's important to have agreements in place early on, before you start actually doing the work, and come to an agreement with respect to who's going to own what's created, whether there's going to be some sort of percentage ownership or things like that. And I think if you do incorporate and you have a shareholders agreement drawn up, that'll address a lot of those questions. And I think it's easier to do that at the beginning, and rather than if you wait and then things start to roll, and things can get more valuable. That's usually when it's harder to come to agreements. So our recommendation is always to try to get things settled right from the start, and have it in black and white.
Okay, I know everybody's time is precious, so we'll do the draw now. And this is a $500 voucher from Bereskin&ParrLLP. The winner is Stephanie Pelche. So Stephanie, I'll be sending you an email and introducing you to Tony. Congratulations.
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 Thank you.
And in closing, I'd just like to thank Tony, Mary, and Peter, and everyone for participating in our event today. Invite you to like us on our LinkedIn page, our Twitter page, our Facebook page, and sign up for our quarterly e-newsletter. You can do that on our website at northernontarioangels.ca. Happy holidays, everyone. Take care and be safe.
Thank you. Well done.
Everyone.
Thank you, everyone.
Thank you very much.
Thank you.
Happy holidays.